Okay, the problem I have with some funds is the structure of them, right? Is that people get locked out of their funds. The funds get suspended. There's a run on the fund. Like normal retail investors get locked out of them. And I'm going to tell you basically how to avoid all that. Thanks. What if I told you there's a risk that your money could be tied up into a fund for months or even years and you wouldn't be able to get to it? What's more, what if the fund manager was charging you a fee for this? How do you feel? Now, before we get into the nitty-gritty of it, this isn't an attack on any investment style or any investment fund, certainly not any fund manager. It's just to highlight the risks that can happen to people. So you probably won't believe how badly things can go wrong with funds and certain fund structures and why it's important to get to know them. But let me just give you an example, a real-life example, and let's see if you can guess who I'm talking about. Okay, so after 20 years of running a highly successful fund, a well-known superstar fund manager has grown this initial fund to about 30 billion, and now he's going to start his own fund in his own name, and starting with about 5 billion. Institutions and private investors alike flock to it. This guy's a household name. He's like known as the housewife's fund manager. If you ask, any middle-class lady a name of a fund manager, they shout out to you. Maybe not that guy. Anyway, so far, so good. Only this time it's a little bit different with the fund. So instead of investing in his traditional fund that he was running, investing in boring, defense companies or tobacco companies that are listed on the stock exchange, he's looking at investing in smaller, groundbreaking companies, disruptors, those kind of small stocks. Now, a lot of those were actually, a material number, were actually not listed on the stock exchange anywhere. So what this means without explicitly saying so is, number one, you can't turn these holdings into cash overnight, like, a regular stock listed on the market, because there is no market for it. You literally have to find a buyer. You have to go to people, usually via banks or intermediaries, to find a buyer for your share of a private company. It's very time consuming, not impossible to do, obviously, but you're not going to just sell them at a click of a button. And number two, in terms of agreeing a valuation for them, there's no agreed price for them on a stock exchange. You just see the prices go up and down, and those are the prices that's being offered. And if you want to sell at that price, fine. And if you want to buy at that price, fine. But there's an agreed price. With privately held companies, these are just it's harder to value. It's more of an art than a science, even more so than traditional valuations. Because of the lack of a market there. So after a few years of good performance, the fund starts to underperform. As a result, a few institutional investors start pulling their money out. And then the FT, the Financial Times, runs a headline that says, institutions are pulling 10 million out of the fund every day. And that really spooks one big institutional investor. They decide to pull 100% of their holdings, equivalent to about 7% of assets under management, in one day. And the fund cannot deliver that. They just don't have the cash to give the investors, the institutional investors, their money back. They're forced to suspend the fund. And what that means is no one can cash in, no one can cash out. 300,000 retail investors have been trapped in that fund. They're likely to be trapped in till the end of 2021. So that's coming up to a couple of years, really, that they'll be trapped in it for. The fund administrator subsequently removed the superstar fund manager and, were in the process of liquidating their holdings. So, of course, we're talking about Neil Woodford and his flagship equity income fund. That didn't turn out so good for a lot of retail investors. Of course, he did very successfully run Invesco Perpetual Fund for about 20 years and massively outperformed, say, like the FTSE 100, avoiding a lot of pitfalls, such as he managed to avoid the dot-com bust. And it was, in fact, Kent County Council on their pension fund, which was the main investor, that actually pulled out of his fund and kind of caused this ripple effect. So it's really important you understand the structure of the funds that you're investing in, because you can be caught short, and retail investors have been caught short time and time again. From property funds back in 2008 Recently, property funds again, just there's a few articles even saying are open-ended investment companies like fit for purpose for property funds, and I would say no. It's a massive red flag, and ordinary investors need to be aware of it, and they simply aren't, just from conversations I've had with a lot of retail investors. So I guess the reason I'm telling you this story is that this could have actually been avoided very simply by choosing a different fund structure. The structure that Neil Woodford had was an open-ended investment company, commonly sort of called unit trusts, mutual funds, and that's different from investment trusts or closed-ended investment companies, right? And if he had chosen to be an investment trust, actually people would have been able to realize their cash. I'll explain the differences in a different video, I think, but it's clear, like, you need to understand what the differences are and invest in the right one that's suitable for you, or you just take the approach that this is a risk I'm willing to take. But you have to acknowledge that this is a risk and it's on the table. I've been quite alarmed by the number of private investors I've had conversations with, and they don't understand what their fund structure is. They don't understand the risks of an open-ended investment company versus the risks of a closed-ended investment company. Okay, what I'll do is a part 2 video, and I'll cover like the different fund structures, all the information, so I've probably scared you enough. I also need to educate you, so you don't make the same mistakes that others have made.